Yeah, good afternoon. MarketChameleon.com. I'm Adam. That's Dmitry over there. Dimitri's on
Hey
all
guys.
this week. How you doing, man?
Good. Good. Thanks, Adam.
We had a lot of good responses from the Dimitri's show on Friday, and he's going to be here all week. So we're going to dive in a little bit today into implied volatility a little bit more. But before we
Yep.
begin, remember everybody, option trading is inherently risky. There's the disclaimer. We're not telling you what to trade. We're just giving you ideas for your trading. So Dmitry, you want to share your screen with us there?
Yep.
Hope everybody had a great weekend. I just got back from the physical therapist. Back's doing okay, except I haven't been doing the stretches, so I'm feeling a little bit twingy. I guess I would put it, but it's all right. We're getting there, man. I'm getting back. I'm getting back into it. So why don't you go ahead, bring down the Skype, Dmitry, and or bring up the yeah, perfect. Bring up the your Chrome, and here we go. There's
Can you see me?
yeah, we got it. We got
Can
the
you see my screen?
Yep, totally.
Okay, let me just try to close this. Can
Perfect.
you still see my screen?
Yep, we're good to go.
Awesome. So I wanted to continue from Friday's lesson on implied volatility. We talked about how you could convert the price, which doesn't actually convey the value of a security every time. And what you do is convert it into a relative value, which you can use to analyze. And we talked about how the implied volatility is an annualized number.
Yep.
And just to kind of come back to and say why do we convert a price into value? Again, it's so this way we could compare it and do analysis. And here Warren Buffett probably says it best. Price is what you pay, value is what you get.
Mm-hmm.
So I found that quote.
Nice. Yeah. Yeah.
So, and just to continue on that path, going for today, what I wanted to do is look at implied volatility and the formula and look at the weaknesses of it. It's important to know the weaknesses because if you want to create an effective model, you want to know where the weaknesses and how to trade around those weaknesses. Okay, so it's not to say it's not a bad model because we don't have anything better that you could apply across the board.
Sure.
But it does have its weaknesses.
Sure. I mean, all things, just like PE, right? I mean, if we just took the PE, you can't compare Google's PE to Walmart's PE or to Netflix's PE, right? I mean, there is a big difference, right?
Exactly.
Yep.
Yeah, and knowing those weaknesses will make you a better trader. It'll make you a more effective trader. Like, I like history, and I was looking at World War II, and when the Germans, they defeated the French, and on paper, the French were a better army, right? They had more tanks, more planes. They were well defended, but they lost the war in like a month.
Right.
And the reason for it is, and here I just brought it up. The Germans just looked and said, okay, this is the weak spot. Nobody's defending it.
Right.
They have this very heavily defended. This was the marginal line. So they just went
and they just went around.
They just went around.
Is that true? That's real? That's actually true?
Yeah.
Here I am. I don't know anything about it. Incredible.
And studying it in trading, it's very important. Just like, in football.
Yep.
If the left side is weak, that's where they pass the ball, right? And that's how they do. They study. And then, when I first started playing chess, you could checkmate somebody in 3 moves.
Sure.
Right. So if you don't know the weak moves,
Yep.
you'll get checkmated really quickly.
Yep.
And that's what we're going to do is just study the weaknesses of this Black-Scholes model.
Cool.
Okay.
Yep.
And the first weakness, I'm just going to put up a note right here. So, the first week, there's a couple of them. And the first weakness we're going to talk about is that when you look at the implied volatility, for example, this number, what it's doing is it's taking this price, this many trading days, this strike price, this stock price, and it's saying that based on this price, what is the average daily volatility in 7 days annualized? Okay.
Right.
So it's converting this into an annualized standard deviation based on these 7 days. Same thing over here. It's taking this price. Let me just take a look.
So that Aussie call was me trying to get my dog out of here. It's decided to use to sit right behind me and just munch on a bone.
Okay.
That's my kid getting him out of here. It's great, man.
Okay. Should we keep going? Is it
Yeah, go, man. Go ahead.
okay?
I was just
Same
letting
thing
people
here.
know that they heard this Aussie. Aussie, that's my kid getting my dog out of here.
Okay. I couldn't hear. So again, just to repeat, it's taking this price, taking these many days to expiration, converting it to an average daily volatility, then annualizing it for standard deviation.
Yep.
And this way, now you could compare which one on a relative basis is more expensive, which one is cheaper.
Right. Mm-hmm.
Okay. Now, the flaw here is when you have something, what it doesn't recognize, and this is one of the weaknesses, is here. I just went to an earnings. What it doesn't recognize is the difference between average daily volatility and an event-driven.
Okay, gotcha. All right.
Okay?
So we're looking at Etsy right here, and so you're right. You're showing us that they're right. It doesn't recognize events happening, right? Basically, right.
Exactly. It doesn't recognize that there's a one-time event. Okay.
Right.
So this is the weakness, right? That there's a one-time volatility event.
Right.
Okay. One-time event. It doesn't recognize that. There's no way to separate that. There's no parameter to separate that out.
Gotcha.
So this price already has that embedded in, that there's right here.
Right.
There's
That
an
there are
earnings,
these
there's
outlier
also
events which tend to cause.
right.
Yep.
Right. But when we run it through the formula, this does not reflect it. So this becomes a little bit meaningless in this situation. Okay. And if you don't know how to use it, and I'm going to explain it to you and give you like another example. I just wanted to show you here. And if I started, before we build a model, an effective, profitable trading model, this needs to be explained, okay? Because a lot of things that I might say may not make sense to you, because if I say, well, in reality, this volatility for 88, you should be buying, and this volatility for 60, you should be selling.
Right.
The model could, okay?
Yep.
And it might not make sense to you, so you have to kind of draw it out. And so that's what we're going to do right now.
Cool.
Okay. And I'm going to use an example that I think it's going to be what let's do this. And this is the first time I'm trying to explain it, so pay attention because it's very.
Well, trust me, I will act as the noob that I am.
Okay.
So yeah.
Okay. So I'm going to try to explain it my best. It's kind of a complicated thing and even a lot of options traders, they don't get it.
Sure.
So
absolutely.
Yep. Let's take a look. And I'm going to do a model where we build out, let's say we take out a loan. We're going to do a carry trade, and I'm going to show you how this works. Okay. So let's say we have, let me just set this up here for a second. So let's just say we have loan A, okay, or note A, okay, and we're going to lend to this note. It'll start making a little bit more sense once put this in. So we're going to lend. So since we're lending, we're going to get interest. Okay. Oh, 1 second. Don't know why I did that. So we're going to get interest on this loan. Okay.
Yep.
And let's just say it starts out January 1st. Okay. And it's going to be for 30 days. Okay. And it's going to cost us $1. We're going to receive $1 per day.
Right.
Okay. Per day. At the same time, since we're lending out, we're going to borrow. Okay. This is called a carry trade.
Okay.
Okay. This is very, and if you look up, carry trades are very popular, with hedge funds and it's the same. It's kind of like you're working like a bank, right?
Sure.
You're trying to borrow at one rate, lend it at a higher rate.
Yep.
Okay. So let's say this This one is 60 days, right? And we're gonna borrow, so we're gonna have to pay interest on this one.
Gotcha.
Okay, we'll pay interest, and we're gonna be paying. For now, let's just keep it simple for this model. We're gonna be paying $1 a day.
Okay.
Okay. They both start out January 1st. Okay, so if we're going to be borrowing, sorry, let me even put this in here. Note B and BR.
Borrowing. Gotcha.
Borrow. Okay, so we're borrowing $10,000 here to lend $10,000 to this guy.
Gotcha.
We're paying $1 interest, and we're going to receive $1 interest. So we're breaking even on the carry.
It's a break-even trade. Yep.
It's a break-even trade, right? Now, this is how the Black-Scholes model will look when you're pricing this, okay? So the first thing, it's going to annualize. It's going to annualize this. And I'm going to show you how to do it. So in this
so it's no longer for
situation,
30 days. It's figured out over the course of 365 days.
Exactly.
Right.
And this is how it looks. So it'll be, okay, you're going to pay $1 per day for 30 days, right? Which equals $30. Okay. Then says, okay, take the $30, right? And this makes it easy over the amount of days.
Oh, yeah.
Well,
okay.
Amount of days, so 30, right, to get an average daily one. So that will be right back to $1, right? Then it takes $1, right? Multiplies it, annualize it, 365 days. That equals $365,
Gotcha.
right, in a year.
Yep.
And then this is the number you're looking at right now in the Black-Scholes. It will take 365 bucks, divided by 10,000, right? Which equals annually 3.65%, right?
Gotcha.
That's what we're looking at, the 3.65%. Okay.
Right.
You're looking. All this then doesn't matter because the formula just spits out this part.
Gotcha.
Okay. Now let's do the same thing down here. Note B. Okay. I'm just going to do it really quickly because we're going to use this as reference as I show you how this model is broken and how you can
take advantage of weaknesses in it. Yep.
You're going to have to take advantage, right?
Yep.
So this is going to be used as a reference.
Yep.
Okay. So just bear with me.
Yeah,
so
go ahead and type those
here.
out. I like the idea of, I'm big on looking for opportunities. You can go ahead and type Dmitry as you enter that in.
Right. So the same thing here is about. Go ahead.
Yeah, I was just going to go through my theory on, it's the way I kind of approach my businesses. Like when I was approaching my podcast or this or that, you look for weaknesses in strategies or in markets. Like when I started the podcast here, the beauty of Costa Rica is literally nobody in Costa Rica listens to podcasts, which allowed me in a Spanish-speaking country to become the #1 podcast in Costa Rica because I could tap into a market of gringos and English speakers who actually did listen to podcasts, right? So that gave me an advantage for the time being until Ticos learn, and Ticos are Costa Ricans, until Costa Ricans actually begin listening to podcasts. It gave me the advantage to become the #1 podcast in Costa Rica. Like do things like that. I love when people are able to break down stuff and find kind of holes or flaws in systems that allow you to take advantage of it. It's one of my favorite things in the world.
Yeah, and that's what's going to happen because a lot of traders, if they're being told something or they're looking at something, it could be deceiving, and they're just falling into something where they think they're doing a good positive edge trade, and it ends up not being what they thought.
Right.
Okay. To the unsuspecting eye.
Right.
So this is here. You could see the annualized rate is 3.65%, 3.65. So it's a break even, right? I'm gonna borrow for 3.65. Right. On plan B, and then I'm going to lend to plan A, 3.65%. So I'm just breaking even on this carry trade. Yep. Right. So here's what now here's the situation where it doesn't. I'm going to put this over here. Okay, this is situation A, I guess we could call it. Okay. This is what the black shows the flaw is it doesn't recognize. It doesn't recognize a one-time event, okay, one-time big volatility event.
Sure.
And let's just say in this situation, on January 15th, once a year, okay, there's a big fee. And I'm just going to make it like, something like extreme just to make it easier.
Sure.
Okay. There's this one big fee of $60. Okay. So let's just put that in there. So this one, let's make it green because I get this interest. Okay. And this one is red because I'm going to have to pay it.
Gotcha.
Okay. And actually, let me change this $1 a day to green just so it's obvious we're receiving it. Okay. Okay, so in this situation, okay, when you look at it, we're still breaking even. Every day I have to, I'm borrowing, I'm paying $1.
Right.
And then from this person, I'm receiving $1. This is going to happen every day. And then on January 15th, right, so this was January 1.
Right.
Right. On January 15th, this one-time event, okay?
Right.
I'm going to receive $60, okay? And up here, and I'm going to have to pay it here.
Right.
So I broke even, okay? Does that make sense? That still at break even?
Yep.
Right? All right. This is how it's going to look on an annualized basis, okay? And this is important. Then I'm going to show you how people unsuspectingly will lose, and the people who know what they're doing would take advantage of that, okay? All right, so here we go. First, we do the same thing. We're going to say it equals, we got $1 per day, right? So in 30 days, it's $30.
Right.
Here, right? Plus, there's going to be a $60.
Yep, $60 event.
$60 event. That whole 30 days is $90. Okay?
Yep.
Now, we're going to take the $90, all right? We're going to divide it by the 30 days we're carrying it.
Sure.
Right? This is our average daily. This is what we receive, average daily. Now, this is how the model is going to work, right? Average daily, $3. Oops, sorry. $3, right? Now, I'm going to annualize that $3, okay? So, sorry, I don't know why this keeps, okay.
Yeah, 3 times 365.
365, right? Hold on, let me put the equals. Equals 3 times 365, okay? So that's annualized, what is that?
It's 1095.
1095, right? So now it's going to say, okay, what's my annualized interest rate, right? So it's going to take the 1095, okay? It's going to divide it by the loan, right? $10,000. $10,000, right?
Yep.
And that interest rate
10.95.
10.95. Okay, so 10.95%.
Yep.
95%. Okay.
Yep.
Now this is what my model's telling me for A.
Sure.
Okay. Now let's look for B. So now it's thinking, oh, I'm getting a 10.95% interest that I'm earning on this loan that I'm collecting.
Right.
Right.
Yep.
Okay. Now look. Yeah, and this 10.95%, this is the equivalent of the implied volatility.
Sure.
That's what okay?
Yep.
All right. Now look how this is going to look.
Yeah, I mean, you can see where it's going
days,
already, yeah.
Right?
Yeah.
So look.
Yep.
For 60 days, I pay $1.
So $60 plus another 60.
Plus another 60, right? What is that? 120. Okay, 120, right? Then just do this. Equals the next is 120 divided by 60
so
days, right?
$2 a day.
equals that $2 a day, right? Then what we do is we take, sorry, I don't know why it just comes off the screen. So then we take $2 a day, we annualize it, 365.
730.
So that's 730.
Yep.
730. Then we take the 730, right? You say that's our total interest, right? We divide it by the same $10,000, right? That we're borrowing. And what's the interest rate here?
7.3.
Okay. So look, 7 equals 7 point exactly 3, right? 7.3.
7.3.
Right. So even though we're breaking even, right? We already discussed this.
Yep.
Right. We're borrowing $1, and we're receiving $1 and we're paying $1 every day. On January 15th, we're gonna receive $60. We're gonna pay $60 throughout this whole 30 days. It's a break even.
Yep.
However, when you're looking at these two numbers, it looks like this is a great deal because I could borrow at 7.3%.
Right.
I could borrow at 7.3%, and I could lend out at 10.95%.
Gotcha.
Okay.
Yep.
Right. So look. So let me now. Oops. Now let me show you this. So I'm going to take this right now. I'm just going to put it down here. Okay. This is scenario 2. Okay. This is, part 2. Okay. This was part 1. Part 1, it worked correctly, right?
Yep.
Didn't have this crazy event in there.
Yep.
So part 1 worked. This would have worked.
Sure.
Okay. Now let's just say I change this $1 a day. Okay. I'm going to change this $1 a day, and I'm going to put it to 90 cents. Okay. So now 90 cents per day. Okay. I'm getting 90 cents per day, but I'm paying $1 every day, right? Every day I'm going to lose 10 cents because I only receive 90 cents, but I got to come up with an extra 10 cents to pay my $1 debt.
Gotcha.
Right? Okay. So do you see here that I'm losing?
Yep.
Right. Every day I'm losing. This one-time event, this $60 is a wash because I'm going to get whatever $60 I get, I'm going to pay out. But every day, every other day, I'm losing 10 cents on this spread.
Gotcha.
Okay.
Is this some sort of magic trick where you're going to pull out a rabbit and tell me I'm going to be a millionaire by losing money at the end of this trade?
Well, I have to explain before if I start to show you models and trading, you have to understand it, right? Because it's not going to make sense to you.
No, I get it. I'm just joking with you about this. I love where this is going. I kind of see it at the end of the road, but I'm not there yet. Keep going, man.
Okay. So here we go. So I'm going to keep this the same. Okay. Yep. Part B, I'm going to keep no B. I'm keeping the same 7.3%.
Gotcha.
Yep. Right. So let's see, what are we receiving on an annualized basis? If we're borrowing at 7.3%, what are we lending out?
Yep.
Okay, so here we go. So let me just.
So 0.9 times 30.
So 0.9, 90 cents times 30.
Yep, it's $27.
It's $27, right? Plus
the 60.
So I'm just going to put this $27, okay?
Yep, 27 plus the 60.
27 plus the 60 plus the $60, right?
Yep.
That's 87, right? $87.
Yep.
This is what we're receiving, $87,
yep.
right? $87. Then what it does is it averages out per day, 30 days.
Right. $2.9 a day.
$2.90 per day, right?
Yep.
Now, oops. So then what do? We take the $2.90. Okay, we multiply it by 365.
Yep.
Right. Annualize it. And that's, I think,
1058.5.
1058.5. Okay.
Yep.
Then we take the 1058.5. 1058.5. Right. We borrowed, or we're lending 10,000.
10 grand.
10 grand. Okay.
10.58%.
So this model, right? This model thinks we are earning on an annualized basis 10.58%.
Yep.
And we're paying, but we're borrowing at 7.3%.
Right.
Do you see the flaw?
Yeah.
So if I told you,
should you do this trade? You're like, yes. No.
this is exactly. So I kind of want to stop there because,
Yeah.
it has to sink in.
Yeah.
But do you see, to the unsuspecting
Yeah.
person
Yep.
looking at it, right? This is one of the, I have to go over each one
Yep.
at a time. Once we break it down, it's like chess.
Yep.
Don't make the first moves bad moves, right? And then you'll get through. So you could see here, right? You're looking at these right? These are the values that I'm equating to the implied volatility, right? The way it annualizes it, because there's nothing in that model, right, to take out those gap. It doesn't recognize that there can't even be a gap, right? That those one-time events, and that's what's going to happen. And that's how that model is broken. That's why when I say we might build a model where it's very well says you should be buying this 88 volatility and you should be selling this, and it's actually a great deal. Okay, right? But you have to realize why it is.
Absolutely.
And that's why we kind of went over this example. Does that make sense?
Absolutely, dude. Yep.
Yeah.
Yep.
Okay. So tomorrow we'll continue on. There are a few other things in there that we have to discuss, before we kind of look at how to build an effective trading model.
Awesome, man. Why don't you bring up your face? That is good stuff. Everybody remember, click down below if you're on YouTube today. Click the subscribe button. Tick that bell. That bell alerts you on your phone. Although I heard it's not really working. I heard YouTube is basically broken and that whole notification system doesn't even really work anymore. But anyway, we try it. But anyway, you can do that. Actually, the best way is follow me or Market Chameleon or iTradeVol on Twitter. And that way, Twitter's really good at notifying. We notify you all that way. That's the best way if you really want to catch us live. So good stuff today, man.
Awesome. Thanks, guys.
All right. Thanks everybody.
Watching.
Have a great day trading tomorrow, and we'll see you again tomorrow afternoon. Take care.
All right. Bye, guys.